Imagine waking up, grabbing your coffee, opening your laptop, and seeing that just one single bad quarterly earnings report from your employer just wiped out your ability to buy a house.
Yeah, or retire early or, start a family.
Yeah,
Just gone.
exactly. Just vanished. So you look at your spreadsheet, right? And it says your net worth is like $11 million.
Which is an incredibly massive number. Most people can't even fathom that.
Oh, totally. It's staggering. But here's the catch. Underneath that massive number, your entire financial foundation is basically hanging by a single thread.
A very thin thread, yeah.
Welcome to the deep dive. Look, if you are listening to this right now, you are likely standing on the precipice of a really major life milestone. You are preparing for a first meeting with a professional financial advisor.
Which is terrifying for a lot of people.
It really is. Walking into that office, it can feel like stepping into a highly exclusive club where everyone is just speaking this bizarre dialect. It's engineered to make you feel like an outsider.
Oh, the wealth management industry absolutely runs on an alphabet soup of jargon.
No.
They will just casually throw around terms like AUM.
Right, which is just assets under management.
Exactly. Or they'll talk about your SWR, your safe withdrawal rate. They'll bring up your LCTG, your long-term capital gains exposure.
It's like a different language.
It is. And it can easily overwhelm someone who's incredibly smart in their own field, but they just haven't spent decades swimming in this specific financial terminology.
So our mission today is basically to be your translator and your strategist.
Yeah.
We are going to arm you with the exact concepts, the underlying mechanics, and really importantly, the specific questions you need to actually command that room.
You want to walk in there with confidence.
Exactly. And we're focusing on a very specific, totally silent wealth killer today. Over-concentration in a single company stock. And the architectural strategies you need to safely de-risk your financial life without getting just eaten alive by taxes.
The tax piece is what paralyzes so many people.
Right. So to do this, we are unpacking a really fascinating stack of sources today. We've got real-world case studies from high-net-worth individuals who are currently navigating these exact crossroads.
Yeah, the real examples are so helpful here.
They really ground it. First, we have a 39-year-old single tech worker. They're living in a very high cost of living area. They have an $11 million net worth, but, and here's the crazy part, a staggering $6.7 million of that is tied up entirely in their employer's stock.
It's just wild to think about, that level of concentration.
It is. And then we have a contrasting case study from our sources, too. A 40-year-old couple, fully retired, 2 young kids sitting on $22 million.
Also an incredible position to be in.
For sure. And we are layering those raw personal snapshots over some highly sophisticated thought leadership memos. These are aimed at institutional family offices, diving deep into structural portfolio risks and the philosophy of building an anti-fragile asset allocation.
Anti-fragile is such a great concept. We'll definitely dig into that.
We will. So, okay, let's unpack this, because it brings us to the ultimate paradox we are exploring today. How can someone be incredibly wealthy on a spreadsheet, yet totally structurally fragile in the real world?
It happens all the time.
Because before you sit down with an advisor, you need a crystal clear understanding of the exact problem you are actually hiring them to solve. Your biggest blind spot walking into that meeting isn't a lack of capital.
No, you have the capital.
Right. It is how that capital is engineered.
And that engineering flaw is what the industry calls concentration risk. If we take a closer look at that 39-year-old tech employee, I mean, this is someone who has unequivocally won the professional game.
Oh, completely.
Building an $11 million net worth before you turn 40 is an extraordinary statistical anomaly. But when you look under the hood of their finances, the engine is just flashing red.
Because of the single stock.
Exactly. Holding $6.7 million in a single ticker symbol means that more than 60% of their liquid life energy is tied to the daily mood swings of one CEO.
Wow. Put like that, it sounds insane.
One sector, one earnings cycle.
Yeah.
It's incredibly precarious.
Let's talk about why intelligent people fall into this trap, though. Because it's not stupidity. It feels like this psychological distortion field.
It really is a behavioral trap.
Yeah, because when you work in a booming sector and you receive employer stock windfalls, which are typically RSUs, right? Restricted stock units, basically just shares given to you as compensation, you get used to seeing that stock climb 20, 30, sometimes 40% year over year.
You start to think that's normal.
Right. The investor becomes completely desensitized to normal baseline returns. If an advisor says they can get you 7%, you laugh at them.
The behavioral finance aspect here is just fascinating. People naturally project the recent past into the infinite future.
Of course they do.
And when your company's stock has essentially minted your millions, selling it feels almost like betting against yourself.
Oh, that makes so much sense. Like you're betraying the team.
Exactly. You work with these people every day. Optimistic assumptions survive much longer than the math actually dictates they should. We saw this historically with the dot-com bubble.
Right. Or even blue chip stalwarts. Think about GE or Lehman Brothers. People assume that because a company is massive and successful today, its stock price is a permanent fixture of reality.
And we know that's just never the case.
Never. There's this visual metaphor from the sources that I really loved. Imagine a beautifully ordered row of identical matte architectural blocks sitting on a table.
Okay, I'm picturing it.
Now imagine one block is like 5 times taller and vastly heavier than all the rest. It looks impressive. But the slightest tilt in the table will cause the entire structure to collapse.
It's top-heavy.
Exactly. That oversized, heavy block is a concentrated Stark position. It looks great until the weather changes. It's like building a top-tier mansion on a cliff edge made of sand.
Yeah, as long as the weather is perfect, you feel like a king.
But you aren't accounting for erosion. A single bad storm, a shift in the macroeconomic climate, and the entire structure just slides into the ocean. The value of the house doesn't even matter if the foundation can disappear overnight.
That is a perfect analogy. And that concentration risk is the perfect setup for the second silent killer the sources highlight: sequence of returns risk.
Okay, yes. Let's get into this, because this one is sneaky.
It is. Sequence of returns risk is perhaps the single most misunderstood mathematical reality in personal finance.
Really? More than inflation?
I would argue yes. Because when most individuals, and honestly even some average advisors, model out a retirement plan, they use a flat average return.
Oh, right. Like using a compound interest calculator online.
Exactly. They might assume the stock market historically returns about 7 or 8% a year after inflation, so they just drag that formula across 30 columns in Excel.
But the real world doesn't work in a straight line. The stock market doesn't pay out a smooth 8% dividend every January 1st.
Exactly. You might get up 20% one year, down 15 the next, flat for 3 years, and then up 30%.
So it averages out over time, but the ride is bumpy. So why does the timing of those bumps matter so much? If it always bounces back eventually, why is sequence risk a killer?
Because a flat average completely ignores the chronological order of those returns. Sequence risk points out that the timing of the bad years matters exponentially more than the average of all the years combined.
Exponentially more.
Yes. If you take a massive hit to your portfolio early in your retirement, or right before a planned transition like, say, stepping away from your tech career to live off your investments, the structural damage is catastrophic, and it's often permanent.
I want to ground this in a real-world mechanism because I think sequence of returns can sound a little too academic for some people.
Yeah, let's break it down.
Think of it like a restaurant's cash flow. Let's say a restaurant averages $100,000 in profit a year. That sounds great on paper, right?
Sounds like a healthy business.
But what if the chronological sequence is that January, February, and March bring in $0 and literally all the profit comes in the summer?
Oh, I see where this is going.
If the owner doesn't have the cash reserves to pay the rent and the staff during those first 3 dry months, the restaurant goes bankrupt by April.
They don't even make it to the summer.
Exactly. The summer boom doesn't matter because the business no longer exists to capture it. The average was 100,000, but the sequence dictated failure.
That is a brilliant way to explain it. The exact same dynamic applies to a portfolio. If you suffer a huge drawdown in year 1 of retirement, your living expenses don't magically pause.
Right, the grocery store still charges you.
You still have to pay your property taxes, your medical bills, your groceries. To generate that necessary cash, you are forced to sell off pieces of your portfolio.
So you were basically selling shares at a massive 50% discount just to buy your weekly groceries.
That forced selling is the mechanism of destruction. You are permanently liquidating the exact shares that you need to fuel the eventual recovery.
Because they're gone. You can't participate in the rebound.
Exactly. So when the market inevitably bounces back 3 years later, your account balance doesn't bounce back with it because you own significantly fewer shares.
Wow. Average returns can really lie to you.
They absolutely can. The sequence in which you experience those returns, combined with your actual withdrawal rate, is what dictates your financial survival.
Okay, so we've identified the two massive traps here. A highly concentrated portfolio colliding with an early market downturn creates a complete death spiral of forced selling.
A total death spiral.
So, how do you find out if your specific plan is vulnerable to this? Because if you just walk into a mediocre advisor's office, they are just going to show you a beautiful chart going up and to the right, hand you a glossy brochure, and tell you not to worry about a thing.
Which is exactly what you don't want. Taking control of the narrative in that very first meeting is absolutely non-negotiable.
Right.
You do not ask an advisor for a rosy projection or a historical average.
Right.
You demand a rigorous stress test.
A stress test. I like that.
The thought leadership memos in our sources outline a very specific methodology for this, which they call the 48-hour exercise.
This is literal homework for you, the listener. You can run these numbers yourself this weekend, or you can explicitly instruct your prospective advisor to build this model while you literally sit right across the desk from them.
I highly recommend making the advisor do it. The framework is brutally pragmatic. Step 1 requires you to identify the single largest concentrated position or risk factor in your portfolio.
Okay, so for our tech worker, that is clearly the $6.7 million entirely in their employer's stock.
Correct. Step 2 demands that you simulate a severe localized drawdown on that specific asset.
Like a bad market day.
Much worse. We aren't talking about a mild 10% correction. You need to model a 40 to 60% drop.
Oh, wow. So for the tech worker, that 6.7 million suddenly becomes, what, like 2.6 million? Just completely incinerated on the spreadsheet.
Just wiped out. Step 3 then introduces the dimension of time, which is where most amateur models fail completely.
Because they assume it bounces right back.
Exactly. You cannot simulate a neat, rapid, V-shaped bounce back. The recovery from the 2020 pandemic crash gave millions of investors a completely false sense of security.
It really did. Everyone thinks the market drops and then hits record highs 3 months later.
It taught them that markets always recover in a matter of months. That is a historical anomaly. You must model a weak, multi-year sideways recovery.
Like a lost decade scenario.
Exactly. Similar to the early 2000s, where the market just grinds sideways and tests your liquidity for years.
A sideways market is so agonizing, it doesn't give you the relief of a rebound. You're just stuck in the mud, slowly bleeding out.
It breaks people psychologically.
Yeah.
And that brings us to step 4, which is adding the real-world friction.
Because your portfolio doesn't exist in a vacuum.
Right. You have to factor in the tax cost of selling off other assets to survive, the reality of restricted trading windows if you're a corporate insider.
Oh, right. Blackout dates where you literally aren't allowed to sell your company stock.
Precisely. Plus, your ongoing, unyielding spending needs during those sluggish recovery years. All of this has to be in the model.
This exercise naturally culminates in, really, the single most important question you will ever ask your advisor. You should write this down, put it on a Post-it, and make it the focal point of your initial consultation.
It is the ultimate test of a financial plan.
The question is, does the current plan survive without forced selling?
If you take nothing else from this deep dive, remember that question. Everything hinges on the answer.
Because if the advisor runs the stress test and the answer is no, meaning you would actually have to start liquidating assets at a massive loss just to keep the lights on, then what?
Then that concentrated position isn't a badge of honor. It's not a high-conviction investment strategy, like a lot of founders like to tell themselves.
It's just a gamble.
It is a fundamental design flaw in your financial life. Your entire survival relies on the market volunteering to cooperate with your personal timeline.
And the market simply does not care about your timeline. It doesn't know you want to buy a house in May. The market is entirely indifferent to you. Let's shift our lens to the other case study from the sources because it perfectly illustrates how risk doesn't just disappear, it just changes shape.
Right, the 40-year-old couple.
Yes, the couple with $22 million. They specifically noted in their forum posts that they meticulously sold off their RSUs as they vested over the years.
So they were smart. They avoided the trap the tech worker is in.
They did. They completely eliminated single company concentration risk. Their entire $15 million taxable brokerage account is fully diversified across broad market index funds and ETFs.
Okay, real quick for the listener, an ETF is an exchange-traded fund. It's basically a basket of hundreds or thousands of stocks you can buy as a single package. So you aren't picking winners, you're just buying the whole market.
Exactly. This couple owns funds with ticker symbols like VUG, which tracks large growth companies, VEA, which covers developed international markets like Europe and Japan, and VSS, which holds small-cap international stocks.
They sound like they followed the golden rule of diversification perfectly. So here's where it gets really interesting. Are they actually safe?
They traded micro risk for macro risk. By selling the single stock, they ensured they won't be wiped out by one company's accounting scandal or a localized sector collapse.
Right. If one company goes under, they don't even feel it.
However, they are holding 100% of their liquid portfolio in equities, stocks. They're entirely exposed to the broader stock market.
And the sources mention they have an annual spend of $410,000, which is massive. It even includes things like a $90,000 a year nanny.
That massive burn rate is the tripwire here. While a single stock can drop 80%, the broader global market can easily drop 40% in a severe recession.
Like 2008.
Exactly like 2008. If that macro crash happens in their first 2 years of retirement, they are staring straight down the barrel of sequence of returns risk.
Because they have no buffer.
Because they hold absolutely zero fixed income. No bonds, no cash equivalents. They have no shock absorbers. To generate that $410,000, they will be forced to sell their diversified ETFs at the absolute bottom of a global market crash.
Oh, wait. I want to push back on the mechanics of solving this, though. Because if I'm looking at their situation and I know sequence of returns risk is the ultimate enemy, why overcomplicate the solution?
What do you mean?
Why does an advisor need to put them in complex municipal bonds or whatever? Why not just take 5 years of living expenses, say $2 million, and just park it in a high-yield savings account or a basic money market fund? Just sit in cash and ride out the storm.
It's a fair question. Holding a massive cash bucket is a very common intuitive leap. And to be fair, it's certainly better than being 100% in equities.
But it's not ideal.
Not at this worth level.
Yeah.
An advisor's job is to optimize the efficiency of your capital. Cash creates a massive drag on a portfolio over time due to inflation.
Right, the silent tax.
If inflation's running at 3 or 4%, and your cash is yielding roughly the same after taxes, your real return is zero, or even negative.
You're slowly bleeding purchasing power every single year.
Furthermore, when interest rates drop, which they typically do during a recession when central banks try to stimulate the economy, the yield on your cash bucket plummets overnight. Suddenly, your high-yield savings account is paying 1%.
Oh, that's true. The rates are variable.
Bonds, however, operate on a seesaw mechanic with interest rates. When rates drop, the underlying value of existing bonds actually goes up.
Oh, interesting. So it moves in the opposite direction.
Exactly. So a properly structured bond portfolio not only provides a yield that often outpaces inflation, but it can actually appreciate in value exactly when your stock portfolio is crashing.
It acts as a non-correlated ballast. The cash bucket just sits there, but the bond bucket actively counterbalances the equity volatility.
You nailed it. Cash is passive. Bonds are active counterweights. Even the other wealthy commenters on the forum thread were aggressively sounding the alarm bells for this couple.
What were they saying?
One commenter explicitly wrote, "If you have 22 million, you don't have to play this whole game. There's a reason rich people own bonds."
Wow. Very blunt.
Another stated that being 100% equity at their wealth level was blowing my mind. It's a stark reminder that fragility isn't just about picking the wrong individual stock.
Right. It's about failing to build structural shock absorbers for the broader macroeconomic weather.
The commenter who pointed out that a safe, conservative 5% yield on their wealth would pay them over $750,000 a year without ever touching the principal. That really highlighted the ultimate absurdity of their positioning.
They could live entirely off the interest and still have money left over.
Exactly. They've already won the game. The prize money is in their hands, yet they're still playing on the hardest difficulty setting by exposing every dollar to equity volatility.
That is such a good way to frame it. Why keep playing when you've already won? Okay, so picture the scene. You're the listener. You're sitting in the advisor's office. You've walked through the stress test. You've identified the structural fragility, whether it's the $6 million single stock block or the zero bond equity exposure. Now we transition from diagnosis to treatment.
This is where things get technical.
Exactly. How do you evaluate the advisor's technical toolkit? It is incredibly easy for an advisor to point out a problem. The true test of their competence is how elegantly they engineer the solution.
The transition from diagnosis to execution is where you separate the pure salespeople from the true fiduciaries. You want to ask the advisor, walk me through the specific mechanisms you would deploy to unwind this risk without triggering a massive tax event.
Because if their only answer is just sell it all, They aren't very sophisticated.
Exactly. Our sources detail several really sophisticated strategies, and discussing these will immediately reveal an advisor's depth of knowledge. Let's examine the concept of an exchange fund first.
Our 39-year-old tech worker is actually already utilizing one of these, right? For $3.3 million of their net worth.
They are.
So for the listener who has never encountered this specific corner of high finance, what exactly is the mechanism of an exchange fund? How does it differ from just selling the stock and buying an index fund?
An exchange fund leverages a specific provision in the IRS tax code, specifically Section 721, which deals with partnerships.
Okay.
It is engineered specifically for executives or early employees who have a massive, highly appreciated, concentrated stock position, and they want to diversify, but they do not want to trigger a taxable sale.
Because the taxes would be millions of dollars.
Exactly. So imagine a structural holding pen created by an investment bank. They invite 50 different executives from 50 different companies, Apple, NVIDIA, Microsoft, Tesla, who all have the exact same problem.
They all have millions in one stock and a massive embedded tax liability.
Right. You contribute your shares of your single company into this partnership pool. In return for contributing your specific stock, you receive a proportional ownership stake in the entire, freshly diversified pool of all 50 companies.
Oh, wow. So instead of owning just tech company A, I now own a slice of the entire alphabet of tech companies.
And here is the crucial mechanism. Because you contributed assets to a partnership, rather than selling them on the open market, the IRS does not view this as a taxable event.
Are you serious? That's incredible.
It is. You achieve immediate broad diversification without paying a single dime in capital gains tax at that moment. The tax basis of your original stock just transfers over to your new partnership units.
It sounds like a literal financial magic trick. You bypass the tax hit and solve the concentration problem instantly. But in finance, every advantage requires a concession. So where is the friction? What's the catch?
There's a big catch. The friction is severe illiquidity. To satisfy the IRS requirements and maintain that tax-free partnership status, the capital must remain locked in that fund for a minimum of 7 years.
7 years. You can't touch it at all.
You cannot access it. Our tech worker noted in their breakdown that their $3.3 million is completely inaccessible until late 2031. You are effectively trading concentration risk for liquidity risk.
You're basically putting your money behind a pane of bulletproof glass for a decade. If you suddenly want to buy a massive house or fund a startup or cover a medical emergency, that money cannot help you.
It is locked away.
Yeah.
So an exchange fund is powerful, but it's rigid.
Let's look at another strategy mentioned in the sources then, one that provides more flexibility. A wealth advisor in the comments suggested exploring long-short strategies. Specifically, they were dropping institutional names like Quantino and AQR.
Right.
How does an algorithmic long-short portfolio actually unwind concentration risk? This sounds like Wall Street rocket science.
It is pretty close. This is a highly active, mathematically intensive strategy, often referred to as custom direct indexing with tax loss harvesting.
Okay, let's use our tech workers' remaining $3.4 million of concentrated stock as the baseline. How does it work?
The investor is long on that tech stock, meaning they own it and need it to slowly be sold off. A sophisticated advisor using these algorithms won't just dump the stock. Instead, they build a customized, highly diversified portfolio of hundreds of other individual stocks around that concentrated position.
So they're building a bespoke index fund right in my own account.
Exactly. Simultaneously, the algorithm will actively seek out specific stocks or proxy indices that are mathematically correlated with your tech stock, and it'll take short positions against them.
Meaning the algorithm is borrowing shares of those other companies and selling them, betting that their price will go down.
Correct. The market is always fluctuating. When those short positions or even some of the long positions in your custom index inevitably experience a drop in value, the algorithm instantly harvests those losses.
It just automatically sells them to lock in the loss.
Yes. It closes the position, realizing a tangible loss on paper.
And here is the beautiful part of the tax code. The IRS allows you to use realized capital losses to offset realized capital gains.
That is the entire engine of the strategy. The advisor takes those harvested losses and pairs them against the massive gains in your concentrated tech stock.
Oh, I see.
They methodically sell off small chunks of your employer stock, generating a gain, but they immediately neutralize that gain on your tax return using the harvested losses from the algorithm.
So they are continuously manufacturing losses in the background to act as a tax shield, allowing them to slowly chip away at the mountain of concentrated stock over 2 or 3 years.
without you paying huge taxes along the way.
It's incredibly elegant, but I imagine it requires serious computational power. You can't just do this manually in a basic retail brokerage account on your phone.
Not at all. It requires institutional-brought software to manage the beta exposure and track hundreds of moving tax lots, which is exactly why those specific quantitative firms were name-dropped in the sources.
It's a prime example of why you might actually need to pay an advisor's fee. You're paying for access to that algorithmic architecture that you couldn't build yourself.
Exactly right.
But let's say the investor doesn't want their money locked up for 7 years in an exchange fund, and they don't want a complex algorithm shorting the market in their account. This brings us to the most straightforward yet psychologically agonizing solution.
Biting the tax bullet?
Yeah.
Yeah.
Just selling the stock outright.
The psychological barrier here is immense. Our tech worker admitted to having a massive mental block about this. Out of their $6.7 million in employer stock, over $5 million of it was pure long-term capital gains.
If they sell that tomorrow, they are triggering a tax bill well north of $1 million, depending on state taxes. They called it the tax tail wagging the dog.
They know the risk of holding the stock is terrifying, but the prospect of writing a 7-figure check to the government just paralyzes them into inaction.
Overcoming that paralysis requires an advisor to completely reframe the client's perception of their own wealth. The most profound piece of advice from the source commentary addressed this directly.
What did they say?
A commenter told the tech worker, "You never actually had $6.7 million. You only ever had the post-tax amount."
Wow. That is a staggering realization.
It's a gut punch to the ego, right? But it's mathematically undeniable.
It completely shatters the illusion of phantom wealth. If you look at your brokerage statement and treat that pre-tax number as your actual net worth, you are living a delusion.
You're counting money that isn't yours.
The government already owns 20 to 30% of those gains. You are simply acting as an unpaid custodian for their money until you sell.
Once a client accepts that the tax money was never theirs to begin with, the emotional pain of the transaction dissipates significantly.
And an elite advisor won't just use philosophy to make you feel better. They will use math. They will run a Monte Carlo simulation.
For the uninitiated, what does that look like?
A Monte Carlo simulation is a computational algorithm that runs thousands of randomized market scenarios to determine the probability of different outcomes. An advisor can map out 2 paths for you. Path A. You hold the concentrated stock, avoid the tax bill, but carry a 15% probability of a catastrophic 70% drawdown, which, by the way, happens regularly to individual tech stocks.
Very regularly.
And then Path B. You sell the stock, pay a guaranteed 20% tax hit up front, but completely eliminate the tail risk of ruin by diversifying into a global portfolio.
When you look at the raw probabilities laid out like that, paying a one-time toll to secure 80% of your wealth is vastly superior to risking 100% of it just to avoid the toll. A 70% drop costs you far more than a 20% tax hit ever will.
It's pure logic prevailing over emotion. Let's shift our focus to the tactical solution for the 40-year-old couple with the $22 million.
Because their problem wasn't concentration, it was their 100% equity exposure.
The sources highlight their advisor, a certified financial planner, steering them toward individual municipal bonds. We touched on bonds earlier as a counterbalance, but why individual municipal bonds specifically, rather than just buying a total bond market ETF?
Right, because if I open my brokerage app, I can just buy a bond ETF like BND and be done with it in 5 seconds. Why go through the hassle of individual bonds?
Because a bond ETF is essentially a mutual fund containing thousands of underlying bonds. It trades like a stock, meaning its net asset value fluctuates daily based on interest rate movements.
Okay.
As we saw in 2022, when the Federal Reserve aggressively raised interest rates, the value of those bond ETFs plummeted. A bond ETF does not have a specific maturity date where you are guaranteed to get your money back. It has perpetual duration risk.
So while it's less volatile than stocks generally, it can still lose principal value exactly when you might need to sell it.
Precisely. Individual bonds fundamentally change the contract. When you purchase a high-quality individual municipal bond, you are lending your money directly to a city, a county, or a state government for a specific infrastructure project, like a toll road or a new school.
And that bond has a fixed maturity date, say 5 years from now.
And the mechanism here is certainty. Assuming the municipality doesn't go bankrupt, which is incredibly rare for highly rated general obligation bonds, the city is legally obligated to hand you back your exact principal on that specific date.
Regardless of what interest rates or the stock market have done in the meantime.
Exactly. You have engineered a predictable, guaranteed return of capital.
And the reason their advisor is prioritizing municipal bonds over corporate bonds or U.S. Treasuries comes down to the tax code, right?
Yes. The interest payments generated by municipal bonds are generally exempt from federal income taxes. Furthermore, if you purchase bonds issued within your home state, the interest is often exempt from state and local taxes as well.
The sources hinted that this couple lives in a high-tax state, likely New York or California. For a couple with $22 million, they are in the absolute highest marginal tax brackets.
The math of the tax equivalent yield is incredibly powerful for them. If a municipal bond pays a 4% tax-free yield, a couple in a 50% combined federal and state tax bracket would need to find a taxable corporate bond paying 8% just to break even after taxes.
Finding a safe 8% corporate bond is nearly impossible.
Exactly. Taking a portion of their $22 million and building a ladder of individual municipal bonds creates a massive, tax-free bucket of cash flow.
It funds their $400,000 lifestyle with absolute certainty, ensuring they never have to liquidate their equity ETFs during a market crash. It completely neutralizes their sequence of returns risk.
It is the perfect structural fix.
We've covered a tremendous amount of mechanical ground here. We understand the trap of concentration, the hidden danger of sequence of returns risk. We know how to run the 48-hour stress test to expose forced selling.
We've got the tools.
Yeah, we've walked through the complex tactical toolkit. Navigating IRS Section 721 for exchange funds, utilizing algorithmic tax loss harvesting, relying on Monte Carlo simulations to pull the tax band-aid off, and constructing tax-free municipal bond ladders.
The mechanics are essential, but the final and arguably most important step in preparing for your advisor meeting is mastering the framing.
Discussing tax codes and algorithms is totally futile if you and your advisor are misaligned on the ultimate purpose of the capital.
The philosophy dictates the strategy. The family office memos in our sources introduce a brilliant conceptual framework for this: anti-fragile allocation.
I want to spend some time on this term, anti-fragile, because I can literally hear the internal resistance from the listener. If you're someone who built an $11 million net worth before turning 40, you didn't do it by being timid.
No, you took big swings.
You took massive, concentrated risks. You joined an unproven startup, you worked 80-hour weeks, you held your equity while others sold. Telling that person to suddenly diversify into boring municipal bonds feels like telling a race car driver to trade their Ferrari for a minivan.
It feels like a downgrade.
It feels like lowering your ambition.
That visceral reaction is incredibly common among self-made wealth creators, and it is a deeply dangerous misconception. The institutional memos address this psychological friction head-on.
What do they say?
They note that diversification is frequently and incorrectly viewed by aggressive wealth creators as an apology for not being bold enough. The authors actually refer to this mindset as adolescent thinking dressed up as conviction.
Ouch. That is a brutally sharp critique, calling a founder's conviction adolescent.
It is sharp because it needs to pierce the ego. The transition from wealth creation to wealth management requires a fundamental rewiring of your ambition. When you are building wealth, your ambition is focused on maximizing the rate of return. How high can I push this number? But once you have accumulated life-changing capital, the definition of success inverts.
It flips completely.
The goal of an anti-fragile portfolio is no longer to optimize for excitement or to beat the S&P 500 so you can brag about your alpha at a dinner party.
The ambition shifts from maximizing returns to minimizing ruin.
Precisely the point. An anti-fragile allocation is engineered to take a severe, unexpected macroeconomic hit, a pandemic, a banking crisis, a decade of stagflation, without ever requiring you to betray your life plan.
The aggressiveness isn't in the risk-taking, it is in the absolute fortification of your lifestyle.
Yes. There is a concept in the source material that ties perfectly into this ego rewiring. They talk about the danger of the biography stock.
Oh, let's explore what that means.
The biography stock is the ultimate manifestation of emotional attachment masquerading as financial strategy. For founders, early employees, or long-term executives, the company stock they hold is rarely just an asset on a spreadsheet.
It's way more than that.
It is the physical representation of their life's work. It represents the missed family holidays, the years of stress, the critical pivot that saved the company from bankruptcy. The stock, becomes their personal history.
It becomes completely intertwined with their identity. So when an advisor suggests selling 50% of it to buy a broad market index, the client feels a sense of disloyalty. They feel like they are betting against their own legacy or abandoning the colleagues who are still grinding at the company.
The sources draw a very hard clinical line regarding this psychology. They argue that there is a definitive point where an investment stops being an asset allocation choice and mutates into a liability of personal history.
You have to separate the emotion from the math.
You must separate your ego and your biography from your balance sheet. If the fluctuations of a single stock have the power to alter your retirement date, force you to downsize your home, or dictate whether you can afford to send your kids to a specific school,
Then it's too much risk.
it requires a hard, mathematically enforced cap. Your identity cannot afford to be subjected to quarterly earnings estimates.
Which brings us to the ultimate mandate you must give your prospective advisor. When you sit down in that office, you look them in the eye and establish the ground rules.
Would it to be clear?
You tell them that you are not hiring them to optimize for a specific percentage return assumption. You are hiring them to optimize for one singular metric: optionality.
Optionality is the true currency of the ultra-wealthy. It is the ultimate luxury good.
Think about our 39-year-old tech worker. Right now, they are single, and their burn rate is relatively low, maybe $100,000 a year. Their spreadsheet says they are fine, but life is chaotic and non-linear.
Things change.
What if they meet someone tomorrow? What if they decide they want to have children? What if they want to exit the tech grind and buy a $2.5 million home in their very high cost of living city?
They need to know they can do that.
Optionality means having the unencumbered freedom to choose any of those divergent paths at any moment in time without needing permission from the stock market.
If your financial plan dictates that you can only purchase that home, or you can only start that family, if your employer's stock stays above $150 a share,
Then you don't actually possess a financial plan. You possess a fragile hope, heavily dependent on the whims of macroeconomics and corporate governance.
building an anti-fragile allocation gives you back your sovereign autonomy. It ensures your choices are dictated by your desires, not by your constraints.
This has been an incredibly deep, systemic journey. For you, the listener, preparing to walk into that first crucial meeting with a professional financial advisor, the terrain should look entirely different now.
The fog of acronyms and sales pitches has lifted.
You know exactly what traps to look out for. You will not be dazzled by a glossy pitch deck showing 20% average historical returns, because you know the restaurant cash flow math. You know that averages hide the lethal danger of sequence risk.
You are walking into that room equipped to control the interview. You will ask about drawdowns, you will ask about liquidity constraints, and the 7-year lockups of exchange funds.
You will ask about the algorithmic mechanics of tax loss harvesting.
Most importantly, you will explicitly command them to model sequence of returns risk against your specific real-world spending needs.
You understand the paradox of paper wealth. You know that a portfolio can look invincible on a spreadsheet, yet be entirely structurally fragile in reality. And you have the conceptual blueprint to start diagnosing and repairing that fragility.
As we wrap up this analysis, I want to leave you with a final reflection to mull over. Our source material briefly highlighted the design philosophy of the legendary industrial designer Dieter Rams.
Oh, I love his work.
Rams famously operated on the principle that good design is as little design as possible. True elegance in design is honest, unobtrusive, structurally sound, and devoid of unnecessary complexity.
Usefulness prioritized above decoration, the structure over the facade.
Exactly the lens you should apply to your wealth. I encourage you to look at your own financial life right now through the philosophy of minimalist design.
Are you hoarding unnecessary complexity?
Are you holding on to a massive single stock position out of ego? Or chasing esoteric private investments just to satisfy a need for excitement? Or are you actively, intentionally trying to build a quiet, clean, mathematically elegant system where no single point of failure, no single bad earnings report, no localized market crash can ever bring down your house?
It brings us right back to the beginning. Think about the architecture of your life. What is the one oversized, concentrated element in your financial structure that is quietly, invisibly straining the foundation beneath it?
Identifying that singular risk is the first step.
Making the hard, mathematically sound decision to fix it before the storm hits is what permanently secures your future. Find the structural flaw, demand the stress test, protect your optionality. Thanks for joining us on this deep dive.